Okay, so you've started a new business, you know there's a mountain of stuff to do. Well, today we're going to tackle one of the big ones, UK corporation tax. And trust me, we're going to make this climb a whole lot easier.
Right, if you've just set up a limited company, then you are in exactly the right place. We're going to make sense of corporation tax for you, from the absolute basics all the way to managing it smartly. And we're going to do it all in the next 5 minutes. Let's go.
Okay, first things first, let's get down to the fundamentals. What even is corporation tax? What are we actually talking about here? So in simple terms, it's just a tax on your company's profits. But, and this is a key thing to remember, it's not just about the profit you make from your regular sales. It also includes the profit, or what they call gains, you make from selling company assets that have increased in value. Things like property, land, or even shares. So who actually has to pay this stuff? Well, it's not just for limited companies. You've also got foreign companies that have a branch here in the UK. And surprisingly, it can even apply to things like clubs, co-ops, and unincorporated associations. Think of your local community sports club, for example. The bottom line is this. If your organization is its own legal thing and it's making a profit, you've got to have corporation tax on your radar. Okay, so now we know what it is. The next logical step, and your first big to-do, is getting your business registered with HMRC for it. And hey, here's a bit of good news that should make things a little easier. When you're first setting up your limited company with Companies House, you can actually register for corporation tax at the very same time. It's all integrated into one process, which is, super helpful. But what happens if you didn't do it then? Okay, first, don't panic. But you do need to know that the clock is ticking. You have 3 months, and that's a hard deadline, from the day your company starts trading to get registered with HMRC separately. So yeah, definitely get that date in your calendar. All right, let's get to the big one. The question every single business owner asks, how much is this actually going to cost me? Let's break down the numbers. Okay, so the rate you pay is all tied to how much profit you make. It's pretty straightforward. If your annual profit is up to £50,000, you're looking at the small profits rate, which is 19%. Now, if your company is doing really well and making over £250,000 in profit, you'll be on the main rate, which is 25%. But what about that big space in the middle? Yeah, that's where this thing called marginal relief kicks in. It's basically a clever system designed to ease you into the higher tax rate. So instead of a massive jump from 19 to 25% the second you earn a penny over 50 grand, it's a gradual, tapered increase. The main thing to remember is that it's a smooth climb, not a sudden cliff edge. Okay, next up, let's talk deadlines. And you really want to pay attention here because this is where a lot of new businesses get tripped up. It's not just one date you need to worry about. There are actually 2 key dates you have to remember. And here's the crucial difference. The deadline to pay the money you owe comes first. That's 9 months and 1 day after your accounting period ends. But then you get a bit more time to do the actual paperwork. You get a full 12 months for that. So the rule to live by is pay first, file later. Got it? Right, and that paperwork we're talking about is a form called the CT-600. And listen, this is so important. You have to file this return every single year. It doesn't matter if you made a loss or if you don't actually owe any tax. If you have an active limited company, filing this form is absolutely mandatory. Okay, so we've done the what, the when, and the how much. Now let's get to the really interesting part, the final piece of the puzzle. How can you legally and smartly manage what you have to pay? First off, let's get something straight, because this is a biggie. We're not talking about tax evasion. That's illegal. It's about lying and hiding things. What we are talking about is sometimes called tax avoidance, but honestly, a much better way to think about it is tax planning. It's the totally legal, totally legitimate process of using the rules, the allowances, and all the reliefs that the government wants you to use to reduce your bill. So one of the main ways to do this is by claiming all of your allowable expenses. Simple, right? These are just the day-to-day costs of running your business. We're talking about office costs, staff costs, marketing, insurance, the whole shebang. Every pound you claim as a legitimate expense lowers your taxable profit, and that, in turn, lowers the tax you pay. And it doesn't stop with just day-to-day expenses. The government also offers some really specific tax reliefs, usually to encourage things like innovation. So if your company is doing any kind of research and development, if you're in the creative industries or you hold patents, there are some pretty powerful reliefs you can tap into. You can even use losses from one year to reduce the profit of another. Seriously, it is so worth your time to look into what your business could be eligible for. And there you have it. That was our quick tour of UK corporation tax. You've got the basics down now, you know the fundamentals. So the final question I want to leave you with is this. Now that you know the rules of the game, are you absolutely sure you're making the most of every single allowance and relief out there to manage your bill in the smartest way you can?
If you are looking for professional guidance, give us a call today. Sit back and relax while we do all the complicated work for you.